Hello, my fellow investors, and welcome to the first earnings report video that I'm doing with a face cam. So this is going to be an interesting one because, I've never done an earnings report one with a face cam before. So, okay, great. Awesome, guys. So today we're going to take a look at the company American Express. They just had earnings on Friday, and we didn't get to it. It was just a lot going on, guys. It really, really was. So we didn't get to it, but I'm going to cover it here for you guys today. I'm here by myself, so you know, it is what it is. Nonetheless, though, let's take a look at this company, guys. Take a look at their earnings report, do a fundamental analysis, and then see if at the current share price, this is looking like a buy using a discounted free cash flow approach. So with that said, let's get started with this analysis. And we're going to start off with, of course, their earnings summary. Now, I'm not going to go over what this company does. They are, just to go over it really, really quickly, they are a credit card provider, right? But their credit cards aren't like a Visa or MasterCard. No, like their credit cards are for like, I would actually argue like the higher end of the middle class to like the rich people, right? To like close to like the 1%, right? So they're very, very close to that kind of. So the people that tend to have their cards are usually people that are very well off, right? Very well off. Not like the Visa and MasterCard kind of crowd. So just keep that in mind. Now, looking at these earnings summary, we could see that EPS normalized actual came in at $2.89. The same thing with the EPS gap actual. However, the EPS normalized actual peaked by 7 cents. The EPS gap actual peaked by 8 cents. However, the revenue, take a look at this, $15.05 billion. This was a miss by $307.27 million. So that's interesting to see, especially after the move that this thing had on Friday, after these earnings came out. So that's very, very interesting. We're going to take a look at that later. So with that, now let's actually jump into their full-on earnings report. And of course, this will be linked in the description below for everybody to read along. So we got American Express reports record revenue of $15.1 billion, up 12%. So this is an example. This is what I love about I love and hate it, right? I love and hate it. This is why I'm like, you need to read the earnings report. You need to read the earnings report because if you just go off of this, you would be like, oh, it missed. Oh, it missed. Right. No. It missed the analyst estimates. All right. It missed the analyst estimates. What I'm looking at as an investor is, are they growing this year over year? That's what matters to me the most, right? This miss over here, all that that's going to do is cause volatility with the stock on the short term. I don't care about that. In fact, you might even capitalize on that. That's what I do. I like to capitalize on the short-term volatility, short-term, stock coming down massively just because they miss. When in reality, when you take a look at the earnings report, they're up 12% from the prior year. That makes no sense, right? That makes no sense. Why would it fall when they're up 12%? Well, it's because they missed analyst estimates. Regardless, though, they're still up, with card member spending reaching a quarter high. Look at that, a quarter high. That's absolutely crazy, guys. Second quarter earnings per share rose 12% to record $2.89. Company reaffirms full year 2023 revenue and EPS guidance. So they're keeping it the same, right? They're not increasing it, they're not lowering it, they're keeping it the same. I love to see this. Now, I wish that they would put in their cash flows, but it is what it is. So let's come down here and take a look at these numbers. Now, the first one we got is total network volumes, and this is in billions. Now, this is the only one that's in billions. The other ones are in millions. You guys can see right over here. Dollar amount in millions per share, except per share amounts and where indicated. So this one is 395 billion compared to now 427 billion. That is up 8%. Total revenues, net interest, this one is in millions. So this 13.4 is 13.4 billion, and this 15.1 is 15.1 billion. This is what we saw up here, where it's up 12%, right? That's where we're seeing that. Total provisions for credit losses, I'm not necessarily sure what this means. I mean, it went up, so I'm assuming because it's credit losses, I'm assuming that this is a bad thing, right? It went from 410 million to $1.2 billion. Net income going from 1.96 billion. I was going to say 2 billion, but then this one is 2.17 billion. There's an increase of 11%. Diluted EPS of $2.57 up to $2.89, up 12%. And an average diluted common shares outstanding, take a look at this, 753 million to 741 million. That is a buyback, guys, of 2%. Already loving this. The only one I don't really quite understand, the total provisions for credit losses I think the fact that this is going up is a bad thing. But again, I don't really own this company, so if anybody knows more about that specific thing, please let me know in the comment section below. All right, let's see what the CEO had to say about this. I'm very, very curious about this. This is pretty much what we just read up there. Okay, so here we have his actual quote. We saw continued strong demand for our premium products with over 70% of the new accounts we acquired in the quarter on our fee-based products. Millennial and Gen Z consumers remain our fastest, that's surprising, our fastest growing customer cohort, representing over 60% of the new consumer accounts acquired globally in the quarter, and spending by this cohort increased 21% over the prior year in the United States. That's fairly surprising because what we've been seeing all around is Gen Z can't afford anything. Millennials can't afford anything. Like we can barely afford houses, right? So, or eggs at this point. So it's just like, that's fairly surprising as to why he's saying that Gen Z and millennials are the biggest consumer in increasing. Very, very interesting if I do say so myself. All right. Do we have anything else here? Well, we actually do have this in relationship to each individual segment. And here we have the American Express company. This is the total company. So it reported second quarter earnings. I know $2.2 billion, whatever, or 2,089 cents. Second quarter consolidated total revenues of 15.1. We already saw this. What I want to see is each individual segment. So this is over here. U.S. Consumer Services reported second quarter pre-tax income of 1.3 billion compared to the so it's the same compared to the 1.3 billion a year ago. So Consumer Services pretty much the same. Commercial Services. This one I'm interested about. It came down. Reported second quarter pre-tax income of $713 million compared to $778 million a year ago. That's a little bit concerning. Not gonna lie. That's straight up concerning right there, because what's the one thing that we've been noticing, guys, with the problems? Commercial back securities, CMBSs, right? CMBSs to be exact. So, oh man, that's a major problem. Total revenues net of interest expenses were 3.7, up 7% from the 3.5 years ago, and the increase was driven in part by higher average loans volumes. That's not good. That's really not. Provisions for credit losses were 339 million compared to the 97 million a year ago. The increase reflected higher net write-offs and net reserves build of $119 million compared to the reserve build of, wow, dude. Total expenses were 2.7 billion, up 3% from the 2.6 billion a year ago, primarily driven by higher operating expenses as well as higher customer engagement costs driven by increased usage of travel-related benefits. All right, and this one over here is the international card. This one, 253 million compared to 283. That's a massive increase, guys. All of this is just a massive increase. Global merchant and network services, 963 million. Wow, look at 802 million a year ago to 963 million. That's crazy. Corporate and other, 445 million. This one actually came down as opposed to 493 million a year ago. All right, guys. Do we have the guidance? I wonder. Do we have the guidance? If I put over here guidance, let's actually take a look at this. Okay, I guess we do have the guidance. Okay, no, we have the guidance there. Okay, so the guidance is actually right over here. Let's actually take a look at this. This is, by the way, to give context, this is in the same area that we saw the CEO's comment, all right? So we got, based on our results to date, we are reaffirming the full 2023 guidance we provided in January for revenue growth of 15% to, keep that in mind. Keep that in mind, because we're going to use that. We're going to use that for the discounted free cash flow, all right? Granted, this is only for 1 year. We use it for 5 years, but just keep that in mind, right? Just keep that in mind. So they're keeping the same revenue growth of 15 to 17% and EPS of $11 to $11.40. We remain committed to running the company with focus on achieving our long-term growth aspirations in a steady state environment. All right. So all of that sounding really, really good. Again, American Express is it's a company that, man, it's I wouldn't say niche, it's not, but I'm saying it's like, how can I say this without sounding weird? It's for people of means, if that makes any sense, right? Like, God, okay. Your average 9 to 5 worker probably doesn't have an American Express card, right? Probably has a Visa or MasterCard. Not that there's anything wrong with that. I have a Visa and MasterCard. I'm just saying, most likely they don't, right? Most likely they don't. Their customers are a little bit higher up, so just keep that in mind. Now, with all of that said, let's jump into the discounted free cash flow, more specifically the spreadsheet. We got the ticker for AXP, market cap of $126.5 billion, a P of 17.25, current share price of $170. Surprising because, well, Johnson & Johnson was the exact same price and we just covered that yesterday. So that's surprising. Now, here's the thing, right? I said, hey, remember the revenues, how they went up 12% year over year, yet the price probably didn't do so hot and you might want to capitalize on this even though it's increasing 12% year over year. Well, here's what I mean by that. If we take a look at this, guys, on the 1 year, this is up 13.34. Year to date, this is up 15.7. Now, you're probably wondering, like, well, what do you mean? Like, it's up. Okay, great. Hang on. Just give me 1 second. 52-week range, $130.65 to $182. So we're near that 52-week high. Here's what I mean, though. On Friday, this thing fell 3.89%. Now, post-market went up slightly, right? 0.09%. All because revenue missed. That's it. All because revenue missed. They reaffirmed guidance. Maybe because they didn't bring up guidance more than what people wanted, right? Probably because revenue missed and they kept guidance the same, which is fine. 3.89% down. So this is the kind of volatility I'm talking about. Don't necessarily trust what the analysts are saying when it comes to, for example, right here, because at the end of the day, it's growing 12% from the prior year. That's a good thing, guys. That's a good thing. So let's keep that in mind as we move on with this. All right. So coming back over here, we can see that they do pay out a dividend of $2.40, which is a yield, it's a tiny yield of 1.41%, a payout ratio of 22.8. 5-year CAGR, almost double digits of 9.86. 1 consecutive year of dividend payment. That's a little bit concerning. So let's take a look at the history here for a second. Okay. They never cut it. In the past 5 years, they never cut it. Let's take a look at this in the 10-year, though. Guys, they never cut it. All right. The reason why, look at this. The reason why, well, they had a split over here, but that was back in the 2000. All right. We can pretty much ignore that, right? Looking at this in the 5-year, guys, they never cut it. The reason why they only have 1 year is because COVID, right? During COVID, they kept it at 43 cents from 2020, beginning of 2020 to beginning of 2022. Can you blame them? Not really. So this is not a case, guys, that's just like, oh my God, they're just cutting. It's so unpredictable. No, they just COVID. So I don't really blame them for that 1 consecutive year. Ex-dividend date unfortunately passed as of July 6th. Payout date will be on August 10th, and they pay their dividends quarterly. Alrighty. So coming back into this, we can see that based off the current shares outstanding, which by the way, guys, it's nothing, and they've been decreasing. We just saw it on the earnings report. All right, they've decreased at 2% in a year. It's really, really good. Now, based off of this shares outstanding and this $2.40, they pay out $1.76 billion in dividends every single year. After this is paid out, look at this free cash flow. Bro, that free cash flow is crazy. All right, that free cash flow you guys are seeing right there, that's insane. After this is paid out in their 5-year average, they still have left $9.4 billion. And after last year's free cash flow, it is a whopping $17.46 billion. Almost double the 5-year average. That's crazy. Gonna have to take a look at those graphs though, because if it's an outlier, it's gonna be a problem, right? It's really gonna be a major problem. So just keep that in mind. These payout ratios are 9% for the last year's free cash flow and 15 point. Okay, their dividend is essentially safe. I get why they cut it because it's COVID unpredicted. I understand that, but man, that dividend is so safe. All right. So with that said, let's jump now into the graphs. So starting off, we got none other than the net income 5 years ago of $6.9 billion to 1 year ago of $7.5 billion, increase of 9%. Big issue here is, well, it's not even the fact that COVID brought it from $6 billion down to $3.135 billion, right? That's not even the problem. The problem is that 5 to 4, that was a decrease. Ignore COVID, massive jump, bringing it back to essentially the median of $8 billion, roughly, right? $8 billion. But then from 2 to 1, the net income came down from 8 8.1 billion to 7.5 billion. That's a bit concerning. The earnings report though is telling us that it is going up. So I'm looking at this and I'm like, I have no idea where this is going. I really don't. I really don't. So I'm going to give it the benefit of the doubt. We just read the earnings report. The earnings look great, right? So I'm going to say not 50, but unfortunately, guys, I have to give this a 65, right? I have to give this a 65 because even though the earnings report telling me is good, if I didn't see the earnings report, I would have given it a 50. The fact that I saw it, I'm giving it a 65, all right? Just, yeah. It is what it is. Looking now into the free cash flow. This one got destroyed during COVID. Look at this. 5 years ago of 7.62 billion to 1 year ago of $19 billion. Increase of 152% with an average of $11.2 billion. Look at that. Wow, guys, look at this. 5 to 4 years ago, that's a massive jump. COVID hit, they brought them down from almost 12 billion down to 4 billion. That's crazy. But they brought it back up, surpassing even that 4 years ago, and then they had a massive spike from 2 to 1 year ago. Normally, this spike would scare me, but we saw this spike over here. So now I'm like, hang on a minute. Maybe they're just used to giant spikes like that. Is that a thing with them? I don't know. So I'm looking at this, I'm like, their revenue has been, well, to be fair, their revenue already increased 12%. All right. From Q2 2022 to Q2 of 2023, 12%. That's massive. All right, that's absolutely crazy. So I'm looking at this, I'm like, I don't like the spikes, but is it normal for them to have the spikes? That's my rationale over here. So I'm actually going to give this, guys, I would say like an 80%. You can make a case for 75, but I'm going to go with 80 because I'm like, I just saw the earnings report 12%. I can't ignore that, right? I can't ignore that. And they're keeping, hang on a second, and also, let's go back to that earnings release, guys. Let's come down over here to the guidance. They're keeping the 15 to 17% revenue as guidance. So I'm looking at this and I'm like, okay, I have to give this thing an 80%, right? I have to give this thing an 80%. So that's the free cash flow, right? Now, let's take a look at the revenue. The revenue is crazy, all right? The revenue is essentially perfect. Now, I know I just used the revenue for the cash flow, but it's all the same thing, guys, right? In order to have a good free cash flow, you got to have solid revenues, right? In order to have solid net income, you got to have solid revenues. So revenue is the top line of everything. So just keep that in mind. Now, if we take a look at this, we got 5 years ago of 37 billion to 1 year ago of 50.68 billion. That is an increase of 37%. The dip during COVID happened. We can pretty much ignore it, but you can see that this is good. This is really good. There isn't a major outlier, but there's a tiny outlier from 2 to 1 year ago, but it's from 40, well, actually it's from essentially 43.8 up to 50. But then I'm like, oh man, this is a little bit, I'm torn. So I'm not going to give it a perfect grade. It's not too big of an outlier either. So I'm not going to give this thing like a perfect grade, but I'm going to go with like a 95% on this one. Really, really good. Really, really good revenue, honestly. And when it comes to the assets minus the liabilities, okay, here we can see it's pretty consistently increasing. Not all the time, though. Decreased during 3 and 2 years ago. COVID, ignore it, right? Ignore it. They surpassed that 1 year ago, going to 24 billion, increasing that over what it was 4 years ago, 23 billion, and so far this year up to 27 billion on the dot. So this is awesome. This is awesome. I'm going to ignore 3 and 2 years ago because that's just no. It was a COVID thing. Done. Average total assets, it is 210.32 billion. Average liabilities is 186.3 billion. Doing the difference, we get $24 billion. Guys, I mean, it's perfect. It's a perfect looking graph. And unfortunately, I know what this one looks like. It's sad, but it is what it is. Cash flow minus the liabilities. Oh boy. Okay. This one, it is not consistently decreasing, but pretty close to that. 1 year from 3 to 2 is when they brought up slightly. But guys, the trend is going down. The 1 year ago, it is way below that of their average. 1 year ago was negative 184 billion. Last year was the average was negative 165 billion. Guys, I'm actually going to give this a 5%. Because they have 1 year of increasing it, but that's it. Pity 5%. Not really much of anything. Now, shares outstanding. Here we go. We already saw this in the earnings report, so this is going to be good. Shares outstanding. And that's why their payout ratio is so low when it comes to the free cash flow. 5 years ago, 847 million. All right, 847 million. Not even a billion, million. That's crazy. I love it. To today of 736 million. Guys, that is a buyback on the 5 year, 13.11%. Previous year to the current year, that's a 1% buyback. It's a 1% buyback. And we just saw the earnings report. That's a 2% buyback from Q2 2022 to Q2 of 2023. That's crazy. This graph looks absolutely gorgeous. Even during COVID, they bought back. So actually, they took advantage. Even when COVID hit, they took advantage and bought back even more, going from 805 to 761. Guys, 100%. 100%. So with 200s, this thing's going to be good, right? This thing's going to be really, really good. And lastly, cash and equivalents, they currently hold 43 million with an average of $30.1 billion. Sorry, I said 43 million, $43 billion. Sorry about that. Now, looking at the overall grades, we gave the net income, guys, a 65, free cash flow 80, revenue 95, assets minus liabilities 100, cash flow minus liabilities 5, shares outstanding 100. That's absolutely beautiful. Overall grade of 78. Guys, it's a good company. It's a good company, right? It's a pretty good company. Main issue here is the cash flow minus the liabilities, but we saw that the free cash flow is increasing. So the main problem here is, well, the liabilities part of it. So it is what it is. Nonetheless, though, maybe they'll continue to buy back in the future. We'll see. Nonetheless, though, guys, really, really solid company. But here's the problem. Here's the catch. What price do we pay for it? Let's find out. All right, guys, so here we have the discounted free cash flow. Straight off the bat, not inputting anything, required rate of return 10%, not adjusting for debt $216, and adjusting for debt $267. Okay, this is already looking amazing. Any number I put in here, it's going to look insane, right? It's going to look insane. With the current share price of 170, it's looking good, guys. It's looking good. So let's input some of these numbers. Now, for the projected share buyback, let's start off with this, right? The projected share buyback, they've been buying back 13%. Now, the problem with that is, are they going to continue that? Don't necessarily know. So I'm going to go a little bit conservative on this one. Let's go with 5 for the low one. Let's go with 7 for the high, for the medium one. And then let's go with 9 for the highest one. Now, for the revenue. All right, for the revenue. This is, well, Seeking Alpha saying 16.2. And these guys are saying in 2023 alone, they're going to do 15 to 17%. So I'm looking at this, I'm like, they're smack in the middle. And this is in the next 5 years that I'm taking this into assumption, guys. That's a problem. Oh man, this is really difficult. So for the median, this is a problem because it's like if they actually do 17% in a year, in 1 year for January to December of 2023, this is in the next 5 years. Meaning I would have to multiply that 17 by 5 in order to get that value, which is going to be too crazy, right? It's going to be too crazy. I'm going to assume worst case scenario. I'm going to assume that they actually don't reach that 17% in the next 5 years. Worst case scenario, right? Worst case scenario. So let's actually say 12% for the median. Let's say 10% for the low one. And let's say 14% for the highest assumption. So let's put 14. And guys, $322 to $382. And then adjusting for debt, $375 on the dot to $437. Margin safety of 510.15, $318.75 to $415.82. It's looking like a great buy. The company's fundamentals are really good. This is telling me that's a good buy, guys. I mean, PE, it's 17.25. It's also looking good. I don't like the fact that it's near all-time, 52-week highs, but I don't know, man. I don't know. That kind of valuation, that kind of free cash flow, that's so crazy. And that dividend is also really, really good. Like the payout ratio, the payout ratio of the dividend is really, really good too. So obviously, this is telling me that's a good buy. Please do not trust this, right? Please do your own due diligence. This is not due diligence. Even though I read the earnings report, I only read a little bit, guys. So do not take my word. Please don't. Do your own due diligence. Every investment is the present value of all future cash flow. This is not financial advice. So all the earnings are always in the description below. Every single one we always do in the description below. The calculators, all available. This one, we got the banks one, we got the REIT one. There's even a dividend tracking sheet if you guys want it. Please do your own due diligence. Just because my calculator says this doesn't mean that you guys may find it the same. My grade was a 78. Yours might not be the same. So do your own due diligence, guys. All we're asking for in return is we give out free content. All we're asking for in return is just like, subscribe, comment. That's really it, guys. And of course, share, please. We would love to get to 3,000 subs by by September 3rd. If we do, Mike will do face cam. I don't think we're gonna hit it, but prove me wrong, right? Prove me wrong. So share. That's the best thing that you guys could do. Like, best thing that you guys could do. And this week's earnings is going to be nuts. So we're going to live stream every single day this week, 6:30 p.m. Eastern Standard. Be there if you guys want to see it. And if not, we'll have the VOD afterwards for you guys to see, all right? Just keep that in mind. That is the best thing that you guys could do for us. Like, subscribe, comment, and of course, share. Thank you all so much. Now, taking a look at this dividend, guys, putting in $5,725, this nets you $80.72. But, I mean, this kind of free cash flow, $400. So, do with that information as you will. Not a company you buy for its dividend, unfortunately, but man, that capital appreciation is insane, right? That capital appreciation, might be insane. Might be insane. So, $80 to me, it's good. Don't get me wrong, but another company you buy for its dividend. And now, taking a look at the overall options chains. Sorry that the camera just got so dark. July 28th expiration date. We can see that these premiums actually don't look too bad on the put side, right? 45 for a strike of 165, 170 strike for 172. The call side look insane. So, I mean, I wonder what this would, I wonder if there's any options for like, I don't know, like October 2023. And we go up to like 270. Oh yeah, there isn't. All right. So I was just worried. I was just checking to see like if any options were like later on at like the 400 strike. It may be, right? It may be. But nonetheless, though, for July 28th, these are the options chains for AXP. And the light is back on my face. All in all, guys, thank you all so much for watching. Really, really do appreciate it. Again, we're going to have a live stream in just a few hours as of you guys are watching this video, 6:30 p.m. Eastern Standard. We're probably going to cover today Domino's, Whirlpool, and Logitech, if I'm not mistaken. But I don't know about Logitech, but Domino's and Whirlpool 100%. And if you guys have any other recommendations for like a third one in the chat, please let us know in the comment section, in the chat, in the live chat, or here in the comment section as well. So that pretty much does it for this one, everybody. Y'all can follow us on the news sites, link is in the description below. So with that said, peace out, and we'll see you all next time.